Real estate investment trusts are basically stocks, but for real estate investors. So each REIT will have their own sector they're investing in. Think apartments, office, manufacturing, timberlands, farming. High risk, typically affected by two things. Majority of it is affected by the strength of the economy. When things are going well, tenants are paying high rents. There's low vacancies. When things aren't, you have tenants leaving or trying to cut rates, or you have more vacancies. And they're also slightly affected by interest rates. When interest rates go up, their cost of borrowing goes up, which means they can't buy as many properties, and then their valuations get hurt. So their properties are worth less because it's expensive to buy them. And then returns typically keep up with inflation, but you're really focusing on the dividends because they have to pay out 90% of their dividend earnings and dividends. It's mostly for dividends. You want to be looking for equity REITs, which are the ones that actually buy the buildings and the properties. Mortgage REITs, you don't want to look for, and that's not usually what people think of when they think of REITs. Mortgage REITs buy mortgage-backed securities or mortgages of these of large real estate companies. So think more like, when banks lending, that's kind of what you're buying, or think more like bonds. Three options, VNQ. I have three options here for total real estate market exposure in the US. They're all good. If you want to throw that in your portfolio and you want to do maybe 5 or 10% of your portfolio in there to get some real estate exposure, that works fine. If you want specific sectors, you can go to Google and you can look up, ETFs for apartments, and there'll be a couple options there for you. If that's all you wanted to know, go ahead and drop a like. And then I will keep going on with a further analysis from here. So obviously, if you don't know, you buy REITs just like you'd buy any other stocks. If it's an ETF, you do it through your brokerage account. Same thing with mutual funds. So let's take a look over here on the right. Let's take a look at each of these. So what's this? VNQ, Vanguard Real Estate. It's going to give you just a lot of exposure to real estate market. One thing I should notice real quick, REITs typically are not very tax efficient. Individually, they pay out a lot of dividends, and they pay out a lot of income and things like that. So best to hold these in tax deferred accounts like your 401k or your Roth. Well, not 401k, an IRA or a Roth IRA. Just know that. All these have low expense ratios that I'm going to show you, right? This 0.12, that's perfect. And it's going to give you tons of diversification. That's why I prefer that over buying individual REITs. If you want to buy individual REITs, or think of it like an individual stock, that to me is more like a hobby, and you enjoy doing that. You do not need to pick individual stocks to be successful with savings and investing. The S&P 500 is average somewhere around 10%, I think. 10 to 12, depending on what years you want to look at, right? On average, yearly. So you don't need to go in and try to pick the best stock to win. You can get these that give you plenty of diversification. It's probably better for you. Let's see. So what's it paying right now? So it's paying about 3.81 right now. As I've said, most of your return is on the dividends, is on that 3.81% dividend. I mean, they'll usually keep up with inflation and the dividend will grow, but they no guarantees there. It's really all about that dividend, since they are paying out 90% of that of their earnings. It's all the dividend. VNQ, the only thing about VNQ I'll note is, let's go take care of their sectors. So you can just see how much diversification, right? We got data centers in here, healthcare, industrial, office, everything, right? Only thing I'll note is this one has is like real estate companies, not ones that buy the physical real estate. They also have here, they have real estate services. So companies that provide services for real estate, think of like management companies that handle rentals, or data companies, or real estate brokers and things like that. So that's one thing about VNQ. It has some real estate services providers. This one over here, USRT, does not. So that's the main difference here between the two. They do not have real estate services. they should just have REITs. And obviously no mortgage REITs. If you're worried about usually at the top it'll say something if it's mortgage REITs, debt instruments, whatever. You can also come down here to the portfolio. You want to make sure that's not mortgage REIT, and look, no fixed income holdings, right? And then they will have some cash, as to liquidate or to buy new properties. Not new properties, excuse me, to buy into these ETFs. Let's see, XLRE is the same as those pretty much, except it's only companies from the S&P 500, so it's bigger companies, probably more stable in the REIT space, but that's about it. And then here's an example. I haven't really looked into this, but this one's for residential and multi-sector real estate. What are they in here? So then, you can go to Google and you can look up what they're in. They're in multifamily. So they have a couple sectors here, actually. Interesting. Multifamily, single family. Okay, what are they doing here? So you have to look into some of these ETFs and see what they're looking at. Kind of a high expense ratio. So residential real estate. Okay, that's their thing there. Don't understand how healthcare comes into play. It might be self-storage, okay, because it's like residential, like people use it, right? Healthcare might be like senior living stuff. It might be what that is. So there you go. So you can look into those. If, like I've said, if you want to do, if you want to go REIT and like say timber, like I'm in a timberland REITs, and you can look it up. And okay, here's 3. And you can go look and, they'll give you a list of the couple REITs and you can research them on your own. To get started and to have exposure to real estate, you really don't need to do that. But if that's what you're interested in, going ahead. You can also do sectors like residential, manufacturing, office. Some of these sectors like timber is super small sector. They don't have domestic only ETFs. They have 2 international ETFs, just for an example. But really, to start, I would just do one of these broad exposure REIT ETFs and then take it from there as you go on. This is not for 100% of your portfolio. Most people recommend maybe 5 to 10%. Honestly, if you didn't have it in your portfolio, that would be fine. They don't do that great. It's not like they're the best asset class in the world. Just adds you a little bit of diversification. That's all it is. But that's it for now. Let me know if you have comments. I answer every comment, and take care.